The gentleman from New Jersey.
Over here. Hi. Thank you, Mr. Chairman. Just a couple of questions on areas. I know it's outside of your regulatory area, but goes to the macroeconomic. One was Mr. Royce brought up before. He gave you all the stats and what have you, the dire prediction with regard to the FHA. And I just want to delve into that just a little bit more. I heard your answers on that. I mean, sort of what some of us are suggesting, the legislation I threw out at the very beginning, is to say that maybe we should sort of treat them with some of the same requirements that we're sort of asking the rest of Wall Street and the rest of financial markets to have some skin in the game and to have proper capital level rate aspects and also leverage ratios. I think from your answer you're saying, well, there's two issues here. What does Congress want to do with regard to housing and getting that going on the one hand, but what do we also want to do to protect, which is your job in part, to protect the taxpayer? How should we, or how can we come down on the one side without harming the other side?
Well, so first, the difference between the FHA and the GSEs had private debt and private shareholders, and that made it more complex in terms of the overall financial system. I think it's undeniable that the FHA loans, because of the low down payments and so on, are riskier than other mortgages being made, and therefore a greater chance of loss, which would be made up by the taxpayer. And that trade-off is your trade-off in terms of what you think is worth, what risk you think the government should be willing to take in order to support the housing market and home ownership. You made the same decision on things like first-time home buyers tax credit. It's a cost to the government, but it supports the housing market. I don't know how to tell you that. That's your trade-off.
Can we do it in a way, do you think, by just raising it up just a smidge? On our bill, we say to 5% down without having a dramatic impact next year?
I don't know how much effect it would have. That would require more study. I think it's the same trade-off, though. You can make the conditions tougher and tougher. That reduces the risk to the taxpayer, absolutely, and it reduces the number of people who can get mortgages.
Okay. Another area outside of yours, but on the macro issue, is the FDIC and the issues. I don't have to tell you what they're facing right now, and one of their proposals I'm reading about is going to the banks and saying, sort of help us out here. Same sort of dilemma there, isn't it? That the banks are going to push back and say, well, if you're asking us to do that, we're just not going to be able to make as many. Our capital level is going to go down. We're going to have a harder time of it. We're not going to be able to make the loans. So where's the trade-off in that situation?
Well, the FDIC has some tough choices because they're trying to replenish the fund without creating a, quote, pro-cyclical effect, that is, without hurting the banking system in a way at a bad time when we want the banking system to be lending. The solution they have, as I understand it, is that even though there be prepayments by the banks, that those prepayments would be treated as assets on the bank balance sheets, and therefore capital would not, at least in a regulatory sense, be affected. And that's the solution they've chosen. So
yeah, and I sort of thought I was reading it that way, but I wasn't really sure, quite honestly, that they were going to treat it that way. And if you do treat it that way, then really what you're doing, aren't you, is just sort of like getting a loan from the bank. It's really not taking the assets off the balance sheet of the bank.
It's like taking a loan, yes.
It's banking a loan. And so really, instead, the way I think of it is, instead of the FDIC coming back to Congress or using that line of credit that they have, taking a loan from the American public, instead they're saying, well, we're going to sort of kick the can down the road and just borrow it from the banks instead and spread it over to them. Is that a right way to sort of interpret it?
It is a loan from the banks, but it's not a loan that requires capital to back it up. And therefore, in that sense, it doesn't crowd out other lending. But there's no good solutions there, and I know the FDIC has really struggled with the right approach.
Yeah, but my understanding is that a real correct analysis of it. It's just a loan from them, and it's really just. And one way of looking at it is that they're really just sort of like creating money at the same time, because you're able to sort of count that dollar twice. Once when the FDIC is able to take it and hand it over to this bank over here, I'm bailing you out with that one, which is what they want to do with it. And the second time they're going to count that dollar when it's still sitting in the original bank that loaned the money, because you're still going to be treating it as capital in that bank so they can loan it out to somebody else. So you're really counting that dollar twice, aren't you?
Well, I don't think it's creating money technically, but it is basically a loan from the banking system to the FDIC, which will have to be replaced eventually by actual assessments on the rest of the banking system.
Yeah, and I can see the clock. Speaking on the actual assessment, real quick, on the aspect of the resolution authority and who actually pays, I still haven't gotten a clear picture on who actually would pay if, heaven forbid, you have this next scenario and then you assess it all out to everybody. Real quick, can you tell us who that would be? How broad is the group of banks that you'd be going after, or financial institutions that you would actually assess? And is there potential that they would just not be large enough to pay? Because it's small.
I think, may I answer quickly? I think there's a lot of unresolved issues there we need to talk about. I think it should be fairly broad. It should be the financial industry, but it should exclude insured deposits which are already, in assessing the size of liabilities that you are going to tax in some sense, you should exclude those which are already paying deposit insurance premiums.
Okay.
Gentleman from